Ticker symbol INTU is up around 48% for the whole year, and this is after they took an 8% hit after reporting earnings. But today, we'll be looking at a clear market leader which has a very wide moat, and why TipRanks has actually rated this stock a 9 outperform based on a strong buy from analyst consensus, but decreased hedge fund trends and overall insider transactions of selling shares. So we'll be talking about Intuit, a professional services company. In their annual report, Intuit says that it helps consumers and small businesses prosper by delivering financial management, compliance, and marketing products and services. Intuit has their own global financial technology platform, and it has so many other different companies integrated into it. On the right side, we can see an illustrative of some of the functions that it offers. In one of the reporting segments, which is called Credit Karma, they actually help people with their financial positions, allowing them to improve their savings, decrease their debt, and all of that. And you can see some of the functions that the app can actually handle and provide value to customers. Now, this company serves over 100 million customers, and they're divided into 4 different segments. The first one being small businesses and self-employed, second one being consumers, third one being Credit Karma, and the fourth one being TurboTax. And we can actually break down their strategy into 3 different pillars. The first one being to improve the experience and results from connecting customers to experts such as accountants. That is one of the services that they actually offer to their customers, which are actually paying their subscription. And it is one that they believe that is not being delivered correctly and that they could get a lot more value from. So they want to focus on that. The second one is that through Credit Karma, they want to keep improving their customers' financial position by reducing their debt and increasing their propensity to save with the tools as the one in the illustrative to the right. And the third one is to position themselves as the center of small business growth by facilitating day-to-day operations. And one extremely positive thing to keep in our minds about Intuit is that they work based on a subscription model. So basically the majority of their services, they will offer them on a subscription model, and they have an extremely high retention rate, meaning that the majority of the revenue is actually pretty stable and very predictable. 2 things which we love to see in this channel. And this is very obvious when we look at their financial metrics, with the return on capital employed being a bit lower than the one we actually usually look for, with an 11% return on capital employed. But I did see that this is caused by a major uptick in their assets 2 years ago, but we will talk about this later. Now, they have an interest coverage ratio of 13 times and a beautiful cash conversion of 161%, meaning that for every $1 they get in net income, they generate around 1.6 in free cash flow. Amazing for the investor. Then they have great profit margins of 75% and a very good operating margin of 22%. Now we can see that their revenue, gross profit, and net income has actually been increasing every single quarter. And although their net margin actually decreased in July 2022, it has actually recovered grounds, and it's right now sitting comfortably at around 20%, with their net income being up 37% year over year. Now, this is also clear to see when we look at their efficiency ratios, as they're all extremely consistent. The one that is a little bit more volatile is return on invested capital, which is actually the one we like to focus on. And we could see that last quarter, it actually came in at 50 times, which is very impressive, especially for a company like Intuit. Now, when looking at their financial position, the first thing I do want to mention is that uptick we were talking about in 2022 of assets. I believe that this was caused because of one of their major acquisitions. Maybe they were acquiring Mailchimp, and that is why their total assets actually increased that much. Now, one thing I do actually like to mention is that their total assets actually remained fairly stable or even decreased by a little bit in 2023, and I believe that this will happen as well in 2024, meaning that the return on capital employed next year will actually be a lot higher than this year, allowing them to actually enter the threshold that we have in this channel of 15%. Now, their total assets are more than double their total liabilities, which gives a beautiful current ratio, and their debt to equity is actually at a very sustainable level as well. This company is not a huge fan of over leveraging themselves, which we love to see. Then this company, of course, gets the perfect fundamental analysis with 8 out of 8 ticks. They, first of all, have low liability risk. They have an extremely solid balance sheet as they can pay their current liabilities only with their short-term assets. They're extremely consistent with their cash flows, and they have one of the most beautiful, growing, consistent cash flows that I have seen in the majority of the companies that I've actually analyzed up to date. Then another tick is that they pay a very solid dividend, which they are actually increasing year after year. And Of course, they do have organic revenue growth, which we have seen. And now the two most important ones, first of all, they do have pricing power since they're charging a subscription, and every time they add a different service, they are actually allowed to increase their prices. And I believe that with all this inflation, Intuit has actually been able to increase their prices without actually losing too many customers, because their services actually allow customers to generate a lot more income, which increases the retention rate and gives this beautiful pricing power to Intuit. And now, when it comes to the most important one of them all, they do have a very wide existing moat. I believe that this comes in the way of the great service that they have actually been offering for a very long time. This has allowed them to build a very wide, very loyal customer base, where the majority of these customers will not swap to a competitor even if given the chance, because they're very, very happy with the service that they're offering. They already know how Intuit works, and they trust the platform and actually believe that it is generating value for them in the form of, for example, saving tax money, improving their financial status, or just running the business day after day. So this is a great competitive advantage, which gives Intuit the edge over other competitors. Now they have a 0.57% dividend yield, which is not a lot, but it's very good for such a fast growing company. Now they do have a payout ratio of 32%, which is pretty solid. And as we can see, their dividends per share, the blue line, has increased at a faster pace than their amount paid, the green line. And this is because, of course, they have actually been buying back some of their shares. In the meantime, another positive tick for Intuit. Now, I don't think we'll ever find Intuit trading at a discount. However, I believe that right now it's trading close to fair value, as it has a PE ratio which is more or less in line with the one it has yielded in the past 3 years, even a bit lower. And now they have a 2.82% free cash flow yield, which is extremely close to that 3% long-term inflation rate, meaning that from the free cash flow yield perspective, this company may actually be at an attractive valuation. But when looking at the risks and possible challenges, I only see two main ones. The first one being the worsening competitive landscape, because Intuit is growing like crazy. They have very solid margins, and this of course attracts competitors who want to steal some market share and duplicate their success. But however, Intuit has been on top of all of this. They're constantly innovating. Right now, they're implementing AI and trying to add that to improve the offerings that they're actually providing their clients. And the second one is performance, or not meeting of performance objectives. Although I put this at a 50% because you never know, people may get tired from the subscription services, or maybe just one bad data breach might actually scare people off. However, I would not be worried about this. This is just me being picky because I couldn't actually find any risks and possible challenges for Intuit that I actually believed in. So I believe that this company is safe for the long term. But before we move into the investment conclusion, I do want to say that this is not financial advice, and I'm not a financial advisor, so please do your own due diligence. However, I do believe that this company has a very strong competitive advantage. It provides consistent, predictable, and growing cash flows, and it has an acceptable return on capital employed, which I believe that will turn into a high return on capital employed in the following years. And this means that they know how to create value for the investor. So I believe that this is a good company, and it will probably be a great investment, but you have to be ready to pay a premium for it. So thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for a free stock.